Hello, everyone. Welcome back to our channel and welcome back to the Capital Insight series from Punjab Capital. This series sits within our Fundamentals Through the Noise series, and today we wanted to talk to you about Indonesia and Indonesia's independence discount. Jakarta's selloff reads more like a currency story, but it is better understood as a re-rating of institutional credibility, and which of the two it is determines whether the move is a mispricing to fade or a correct fear to respect. The tape is unambiguous out here. The Rupiah broke through 18,000 to a dollar for the first time since 1998 records, and the Jakarta composite is the worst performer amongst more than 90 global equity gauges this particular year. Foreign investors have pulled out almost 3.5 billion from the equities, and still Indonesia has been installed as a consensus in the Asia trend. Read literally, it is a balance of payment story. A net oil importer caught in the West Asia conflict with the Fed higher for longer. That rating is real, but it is still incomplete. The external shock is definitely the trigger. What the market is actually repricing is the cost of a 25-year institutional settlement. Let's talk about what is being discounted. After 1998, Indonesia earned its way back into the global portfolio on a specific bargain, an insulated central bank, conservative fiscal management, and open markets. Investment grade was the reward. Three moves have put the bargain in question at once. Bank Indonesia is buying government debt under a burden sharing agreement and now holds roughly 27% of foreign bonds, an unusually high share for an emerging market. And the source of life question out there is whether liquidity support has quietly become policy monetization. A legislative amendment has broadened the central bank's mandate to include growth and job creation, subjected its performance to parliamentary review, and introduced a mechanism for early removal of the board members. Add to this a fiscal angle that the markets trusted most departed when Shrimilwani and Rawati left in 2025. Now, none of this is fatal alone. Together, they change what an investor is buying, not credibility-anchored market, but one whose anchor is being renegotiated in public. The mechanism is a cost of capital re-rating. When monetary policy is perceived to be captured for short-term political objectives, the structural cost of capital rises, and the evidence is already in the price. 10-year yields sit above 7.5%, the highest since 2022. Foreign holdings of government debt are down by 9% since August. And the rating agencies concur, with Moody's and Fitch both on negative outlook and S&P conditioning investment grade on rebuilt fiscal buffers. Credibility of this kind is hard to earn and easy to lose. That asymmetry is the whole danger. The premium that took 2 decades to build is now being repriced in a quarter. Let's talk about the case it has overshot. Now, the fair counter is that almost none of this is awarded on the underlying economy. Growth is still running above 5%, government debt remains relatively low, reserves cover 5.5 months of imports and debt service, the nickel position is irreplaceable, and 280 million increasingly affluent consumers are not going anywhere. Now, the investability flags that compounded the sell-off, concentrated free floats, and then disclosure are structural legacies that predate this administration and are being addressed. The index valuations landing on June 22nd are the consequence now coming due. What is being priced is the execution and the clarity. A state-led export model announced in late May and is still being specified. That is re-rating of governance legibility, not of the fundamentals, and legibility, unlike a broken economy, is repairable. The surprise 25 basis point hike to 5.5% and the pledge to let yields rise are evidence that the central bank, when forced to choose, still defends stability. And this brings us to the allocator question. The question is not whether to join a crowded exit. The exit is already crowded, but whether the discount has overshot what the institutions warrant. That resolves on signal and not on price. The discount narrows only when the institutional read clarifies, and until then, the discount is the position. In wrap-up, we can say that the independence discount is repairable, but it is not self-correcting. It narrows only when the institutional signal clarifies. A fiscal anchor markets trust, a central bank visibly free to prioritize stability, and a state capitalism agenda specified rather than improvised. None of that is precluded. Indonesia rebuilt exactly this trust once before, and the arc from 1998 to investment grade is evidence that it can be done. However, it is earned on signal and not asserted on conviction. until the institutions read clearly again the discount holds. And what we need to do is watch the institutions and not the Rupiah. That's all that we have for you in this update on Capital Insights. Stay tuned in for more.